The S&P 500 index reveals a critical shift, breaking decisively upward and clearing a multi-month ceiling of resistance. Because digital assets remain highly correlated to equities, this breakout provides a massive macroeconomic tailwind, mapping directly onto Bitcoin's trajectory. Broadly speaking, institutional trading environments are currently operating in a confident, risk-on state. Capital is flowing back into the markets. But beneath that broad market optimism lies a direct contradiction. Look closely at the short-term data, and Bitcoin's immediate microstructure is flashing explicit mathematical warning signs. Evaluating a financial assets trend exclusively on a multi-month timescale is an analytical error. A macro trend gives you the broad direction, but it entirely masks the violent volatility happening at the local level. We define this hidden daily mechanics of price action as the market's microstructure, the actual engine of order flow running beneath the surface. To accurately read this underlying engine, we isolate three specific variables: the momentum exhaustion, multi-time frame divergence, and order book liquidity. These three variables act as localized gravitational forces. When they align, they possess the mechanical strength to temporarily override broader macroeconomic sentiment. By systematically layering these metrics over the current chart, the data mathematically projects why an immediate short-term market pullback is the highest probability outcome. Macro trends provide the destination, but micro frictions dictate the exact path. This chart establishes Bitcoin's structural battleground. The shaded box between $72,000 and $76,000 defines the macro ceiling trapping price. Recently, every attempt to penetrate this bandwidth was rejected. Price must close above $76,000 to clear a path toward the mid-$80,000s. Because Bitcoin dictates the flow of liquidity, the broader ecosystem of altcoins acts as beta assets. They take their structural cues directly from how Bitcoin handles its own resistance. This is the Ethereum chart. Price just broke above a heavy resistance block sitting between $2,150 and $2,250, returning to bounce off it as new support. This completes an inverse head and shoulders pattern, establishing a technical target just above $2,400. Solana provides a sharply contrasting example. Rather than flipping resistance into support, it is currently trapped directly beneath a heavy short-term ceiling. Its exact resistance threshold sits tightly compressed between $85 and $85.50. Both setups, Ethereum's bullish geometry and Solana's tight compression, are entirely fragile. They depend on Bitcoin avoiding a violent rejection from its $76,000 blockade. The logical next step is determining if Bitcoin currently possesses the physical market energy required to break that $76,000 ceiling. Structural boundaries map out where the price is struggling. To understand why it might fail, we must measure its internal momentum. We measure that energy using the Relative Strength Index, or RSI. This oscillator tracks the speed of incoming price movements. It does not measure absolute value, but momentum exhaustion. The mathematical boundaries identify precisely when an asset has moved too far, too fast. Analyzing the macro timescale first, we look at the weekly chart tracking multi-year price transitions. The weekly RSI recently dropped below the lower threshold, flashing a massive oversold signal, an extremely rare metric last confirmed in mid-2022. Macro oversold signals do not pinpoint an exact daily price floor, but historical data shows they consistently identify high-value, multi-year accumulation zones. Now, contrast that macro optimism against the micro timescale. We pivot sharply to the 4-hour chart, which measures immediate, reactive market volatility. On this rapid scale, the RSI is aggressively piercing the upper boundary, registering as mathematically overbought. An overbought microsignal indicates immediate overheating. The buying momentum is physically exhausted, which forces a localized pullback to reset the market, regardless of the macro uptrend. This creates a strict timeframe paradox. Long-term investors are receiving historical buy signals, while short-term algorithmic systems are receiving immediate warnings to sell. The macro data suggests multi-year safety, but the 4-hour microdata proves the current rally is mathematically overheated and vulnerable to an immediate correction. We prove this short-term exhaustion by tracking bearish divergence. On the 4-hour chart, price candles are clearly forming higher highs. Now compare that directly to the RSI beneath it. At the exact same time price climbs, the momentum oscillator is forming lower highs. When momentum dies, we have to calculate exactly how the price will move next. This introduces the concept of liquidity acting as a directional vector. Leveraged traders cluster their stop losses and liquidation targets at predictable levels above the current market. We can track these overlapping orders using a liquidity heat map. This chart overlays live order book density directly onto Bitcoin's price axis. We can identify the precise critical liquidity cluster, a dense wall of leveraged stops sitting exactly between $73,200 and $73,300, just above the current local peaks. Market makers require massive depth to fill large orders. They find it in these stop-loss clusters, pulling the price toward them to hunt necessary liquidity. This constant search for depth creates a gravitational pull, dragging price toward these zones to harvest liquidity before a reversal. The price is not moving up because demand is strong, but because it is being mathematically pulled toward these clusters. Once those orders are harvested, the pull dissipates, often leading to an immediate reversal, as the sudden influx of sell orders from those liquidated positions overwhelms the remaining buyers. By combining these analytical layers, we assemble the final structural model of the market. We have the heavy resistance box, the bearish divergence lines, and the glowing liquidity cluster, all occupying the same immediate space. The asset is backed by macro tailwinds, but critically overextended on the micro scale. The path of least resistance projects a violent upward wick to execute the $73,300 liquidity cluster. Once absorbed, bearish divergence takes control, forcing a downward curve. Without a momentum reset, Bitcoin physically lacks the structural energy necessary to break through the true $76,000 macro resistance ceiling right now. These pullbacks serve as a mechanical reset for overheated oscillators, clearing out over-leveraged positions to prevent a total structural collapse. These localized dips are the very mechanisms that allow the broader S&P 500 correlated macroeconomic uptrend to eventually resume safely. Anticipating these exact micro-frictions prevents sophisticated investors from accidentally deploying capital into momentum exhaustion at the worst possible moment. Blind faith in long-term trends often leads to short-term slaughter in leveraged environments. Mastering the interplay between multi-time frame momentum, structural resistance, and liquidity magnets is the precise process of mapping the mathematical reality of the market.